In this video, we're going to look at the admission of a partner to a partnership. So, let's start with a review. Just one question. When a new partner is admitted to a partnership and contributes assets, how are they valued? Well, if you don't remember what happened in the last lesson, they should be valued at the fair market value. And it has to be agreed upon by all partners. Here's some questions for thought. How does a statement of owner's equity differ from that of a sole proprietorship? How do partnerships account for the admission and/or withdrawal of a partner? And what happens when a new partner is admitted to a partnership and pays either more or less than the share of the company agreed upon? So, we won't be able to answer all of these questions, but we will be able to answer some of these questions in this lesson. So, let's start with the admission of a new partner. There's two ways it can happen. One, we already know from our characteristics of partnerships, as soon as somebody enters or dies or withdraws from a partnership, that partnership is dissolved and a new one begins. So, the admission of a new partner dissolves the existing partnership and begins a new one. Two ways to admit a partner. One, purchasing the interest of an existing partner. And two, the other alternative is investing assets in the partnership. And this one will follow the fair market value. Purchasing interest. So this is really important. This is where the new partner purchases interest of those of other partners who currently have interest or own part of the partnership. The transaction occurs between the new partner and the existing partner and is separate from the partnership entity. So if partner A and B are currently in a partnership and person C wants to join, what happens is person C will pay A or B a certain amount. That amount is not recorded on the books. Exchange of cash between the partners is not recorded. Price is negotiated between individuals and may be different from the partner's capital account records. Here's the only thing that is recorded when admitting a new partner, and cash is involved. Only the transfer of a partner's capital is recorded. All cash is dealt with between the partners. That is not on the books of the partnership. Purchasing interest example. So journalize the admission of J. Adams, November 9th, where P. Singh agreed to sell half of his interest for $90,000. Be careful. Try and pause the video at this point and see if you can figure out what the journal entry will be. Let's continue. Well, half of P. Singh's interest is 150 divided by 2, which is 75,000. Remember, this $90,000 means nothing. It could have been $1 million. It doesn't matter. It could have been $1. It is not going to be recorded on the books. All we're doing when we admit a partner is going to end up changing the capital balances. So P. Singh's will end up being debited 70,000 because his value is going down, and J. Adams will be credited 70,000. Date November 9th, decreases 75,000 for P. Singh, and J. Adams is added. That's credited 75,000, and our comment to record the admission of J. Adams by investment. Now here's another example. Investment of assets. Journalize the admission of J. Adams, November 9th, by investing $50,000 cash, $30,000 worth of accounts receivable, of which doubtful accounts show $5,000, and a vehicle originally purchased for $10,000 has accumulated depreciation of $2,000 and a market value of $7,000. This is pretty complicated. Some parts are pretty straightforward, but some are a little bit more complex. Pause the video and see how you would end up doing the transaction. Some of this is pretty straightforward. Cash, that has no change in market value. $30,000 worth of accounts, you might have the idea that you're going to take 30,000 minus 25, but we actually keep both of these accounts when we end up transferring or admitting the partner. What do we do with the vehicle? It was purchased for 10, has a depreciation value of 2, and a market value of 7. Well, it should be valued at 7,000 because that's the fair market value. So here's our entry. Bank 50, accounts receivable 30, vehicle 7, that's fair market value, and we still have to use a contra account for the allowance for doubtful accounts. That's 5,000 on the credit side. Whatever this ends up being, We end up balancing it out at the end with 82,000. That admits J. Adams, and he is now a part of the partnership. The easiest way to do this is to try and figure all these other numbers and then just figure out whatever's left over following the double entry of accounting. Here's a story, don't copy. J. Adams invests $200,000 into the partnership, the P. Singh and A. Galley partnership for 25% ownership. Before admission, this is what it looks like. P. Singh has $150,000 invested and A. Galley has $200,000. The capital total is $350,000. And here's their ownership as percentages. Now your initial reaction might be, okay, if J. Adams invests $200,000 into this partnership, why don't we just throw that into the capital? Debit capital $200,000. But look at what the problem is. Capital balances then add up to $550, and if we look at the percentages of the ownership, this is not 25%. There's a big problem here. So how do we end up doing this? How do we end up changing this so that this is 25%? So what do? How do we adjust for this so that J. Adams has 25% ownership? Well, we're going to have to end up crossing this out, saying this is 25. What's 25% of 550,000? Well, we're going to find that out in the next set of slides. And then, if this is 25%, what happens to all the other extra money that's left over? Where does the capital go? We're going to disperse it. How? This is what we call a bonus. A bonus to old partners. A bonus to old partners can occur when a new partner invests more than the actual ownership agreed upon. That's exactly what you saw in the last example. A bonus to a new partner occurs when a new partner invests less than the actual ownership agreed upon. Reasons for bonuses to old partners. Appreciation of asset. Maybe market value is greater than the book value. Perhaps there's effort of old partners. Let's take a look at what happens in the next slides. Here's the bonus example. Exactly what you got to see before. J. Adams is investing $200,000 into P. Singh and A. Galley partnership for 25% ownership. Here's what we do know. We know that once J. Adams is added to the partnership, we end up having a change. There's going to be now $150,000 plus $200,000 plus $200,000 is a total capital of $550,000. What's 25% of this? Well, that's how much J. Adams will get. 25%, which is $137,500, which means there's a bonus of $200,000 minus $137,500, which is a bonus of $62,500. Now the hard part is, how do we end up dispersing this $62,500? I'm going to go back a little bit so that we can see what the current ownership is currently before J. Adams is added to the partnership. This says, based upon our current capital balances, there was $350,000, of which 43% was owned by Singh and 57% was owned by Galley. So we're going to take that $62,500 and end up divvying it up according to the 43% and 57%. Let's continue. So, of the bonus, P. Singh gets 43% and A. Galley gets 57%. Now you hopefully are clear on where these numbers are coming from. This is challenging stuff. You have to be really careful to keep track of everything. P. Singh gets a bonus of 43% of $62,500, which works out to a dollar amount of $26,875. We could end up taking $62,500 and subtracting this amount, or if we want to double check, we can end up doing 57% of $62,500, and it gives us $35,625. If you want to double check that this is right, add these numbers together, and hopefully you should have $62,500. What does our entry look like? Well, here it is. Bank gets debited $200,000. J. Adams capital is $137,500, which is 25%. Singh capital gets a bonus of $26,875. A. Galley gets a bonus of $35,625. This is challenging stuff. It's not easy. There's an awful lot of numbers going on, and I'd say that if I got this in the first time I went through it, I'd be lying. So Don't feel bad if you didn't. That's also why I asked in the previous lesson that you guys go through bonuses before you get here, because it takes more time to go through it. So, as usual, practice makes perfect. Here's some more reading for you to do. This is what's expected, that you should be able to create a statement of owner's equity by the end of this lesson. By the end of the homework or classwork. Attempt the do-it questions before looking into the solutions and add the example to your notes. And here's some additional questions for you to attempt on your own. I hope you've enjoyed the video. If you have any questions, drop me an email or throw a question up into the stream. Bye for now.